Coming up in this episode, the SP 500 closes at its highest level in over a year, the NASDAQ on its 8th weekly green candle, the media keeps proclaiming it's a new bull market, interesting comments out of JP Morgan's chief investment officer, RV sales tank over 50%, and the big inflation report due out tomorrow that's going to affect the Fed's decision on Wednesday. Hey, what's up guys? Welcome back to Click Capital. Hope you had a great weekend and a positive start to the week here as the market prices in a soft inflation report due out tomorrow, which should make the Fed pause on Wednesday. And with that, we saw mega cap tech as the winners again today across the board with some good moves in the semiconductors, a little bit of positive move in consumer cyclicals, and healthcare, utilities, and energy especially came off with the price of crude. And just looking at a weekly chart here of the S&P 500, you can see the highest we got back in August last year was 43.25. We actually closed today at 43.38. And the NASDAQ already took out those yearly highs a few weeks back, and we're now on the 8th consecutive green candle here on the Qs. So if we were to close green this week, that would be the 8th week in a row we've closed higher than when we opened, and you'd have to go back a couple of years to see the same consecutive streak as that. So since the crowd reacts to price action, it's no surprise that we're seeing a lot of commentary out from journalists, the online media, Wall Street analysts, and a lot of other people with headlines like this: tech stocks are in a 1995 moment and poised to boom on the AI revolution. Here's another one from Market Watch: it's a bull market for stocks. Here's what that means. And here's another one out today: it's a new bull market, 13 stocks that jump 30% or more every time. So it seems pretty easy, right? Just follow the media and what they're saying. Apparently it's a new bull market. You can just buy all these AI stocks and they should just keep going up and up. However, that's what all the media and journalists and a lot of other pundits that don't actually trade or manage money are saying. But if you look at the people who actually manage money and have a track record, like JP Morgan's Bob Michel, who manages $700 billion, and he said today bull run reminds him of a lot of the calm before the Lehman collapse. And for those of you who don't know, early in 2008, there were cracks in the financial system. JP Morgan bought Wall Street's fifth largest investment bank, Bear Stearns, in a government brokered deal to prevent it from collapsing. And then after that, a lot of the media and the markets thought it was all resolved, everything was good, and the market went on to a 3-month rally. Before we got the Lehman collapse later that year and global financial markets went into a tailspin. And so he's saying he feels like this could be a similar period just after they acquired First Republic Bank, and the markets seem to have put that all in the rearview mirror. Even though with 3 of the 4 largest bank failures in US history just occurring, it's a buzz surrounded generative artificial intelligence that's really getting the stock market excited about the future prospect of growth. And another indication that things aren't all that rosy are RV sales, which can be like a little known indicator of discretionary spending and how the consumer is actually performing. We've got sales of RVs actually tanking off more than 50% this year. And like Michael Hicks says, who is a professor of economics at Indiana's Ball State University, says RV sales are actually better than economists are predicting a downturn. And sales of RVs are down more than 50% in 2023. So this is just another sign that things aren't all that great out there when you look underneath the hood. If you can look past the charts of mega-cap tech stocks and into the real economy, consumers just aren't spending on highly discretionary items like RVs. But the reason why we're seeing a rally today is the market is expecting the CPI report that's going to come out at 8:30 a.m. tomorrow morning to show that inflation is continuing to cool off and expecting it to come in at an annualized rate of 4%. And that should help the Fed make up its mind and pause when they come out on Wednesday with their latest decision. And that's what the Fed Fund futures market is telling us as well. About an 80% probability they're assigning that the Fed will pause on Wednesday. However, they're still giving it about a 74% chance that they will hike in July. However, I wouldn't be surprised if they do hike tomorrow. I know that will surprise the markets a lot. However, I mean, the jobs market's still tight. Inflation's still double their target rate. We've got stock markets at yearly highs now. NASDAQ ripping. There's no reason why the Fed couldn't just front load their decision in July and just get it out of the way and then maybe reassess in July instead of pausing now and then just hiking in July. If I was Jay Powell, I would just front load it and get it out of the way while you still can. But the market is still very optimistic, and we can see that in the fear and greed index ticking up a little bit here today to 78 in the extreme greed zone. And a pretty busy day in the options market for a Monday, 38.5 million contracts and another huge 59% calls, with of course a lot of them in the mega cap tech and once once again that unusual put activity in the high yield corporate bond ETF. Dark pool buyers pulled back a little bit here today, and corporate insiders continue to sell a lot more stock than they're buying, outnumbering purchases 3-1 on Friday. Okay, back into the stock charts, and the international stock indices are all showing signs of holding support here a little bit. Jump up in volatility land today, as you'd expect going into CPI tomorrow and the Fed on Wednesday. Fix 1 day at 16.75. Got the 9 day at 15.3. And the regular fix 30-day jumped up 8.3% to 15. So still very low levels, and if we do get any surprises tomorrow on the inflation report, and especially on Wednesday, we should expect the market to reprice and adjust pretty significantly on that. However, as it stands, the probabilities out there is that inflation will come in soft tomorrow and the Fed will pause on Wednesday. And since we've already had a great run up into that, maybe the market can still pull back a little bit even if we get that. However, that's still yet to be seen, as we do have a little bit of positive momentum in stock prices. And we've still got the VVIX index holding up a bit better than the volatility indices themselves, and the SKU index as well, almost breaking out to highs here at 157. Breadth improved today, 78% of stocks above their 20-day average, coming up to levels normally associated with short-term tops. And overall in the market, we've just got a little bit more than half of stocks above their long-term average. The amount of stocks making new highs versus new lows continues to improve and hold up somewhat. We got growth versus defensive sector spread breaking out to new highs again today. And there's that small cap versus the SPY spread just continuing its 3-day pullback here. Looking for this to hold above the 50, as we think this could be a bottom out in small caps. There's the government bond 2-year yield holding steady at 4.58. Got the 10-year as well at 3.74. And you look at the price action in the September and December Fed fund futures contracts. That doesn't look like the market's thinking the Fed's going to cut anytime soon or later this year. Got the dollar holding steady at 103.60. And commodities had a bit of a pullback today and lost that big support zone. And that's on the back of the move down in oil. Back down to 67 a barrel here, and we do have some inventories in oil building around the world, and with that weaker demand coming off from China and Europe already in a technical recession, the price of crude is a bit of an economic indicator around the world for global growth, as is copper as well, and that's been trading weak as well. Contrasting that is uranium, which had another good breakout today, up 3% on volume. There's the AI ETF finding new highs year to date. Another good day in the clean energy ETF, and semis as well, up almost 3% and almost finding new year highs. Energy stocks came off, but still holding up better than the price of crude. A little bit of weakness in the financials. Industrials coming up to test yearly highs, and the defensive sectors, healthcare, staples, and utilities trading relatively weaker. Tesla finished higher, but did an inside day. That's where we've got a lower high and a higher low than Friday's candle, and we're still in this really elevated overbought level up here. NVDA did an inside day as well, and couldn't get up as much as the overall semi sector, which is close to breaking out to its highs. However, I wouldn't be surprised if we see another big green candle here from NVIDIA into the 400s, maybe come retest that 420 area. Apple as well, coming up to test that highs after the day we got out the new VR headset, and the other big guys, Microsoft, Amazon, and Google, still pulling back a little bit after we had that big reversal candle last week. Performing a bit better is Meta, AMD, and Netflix holding up a bit higher. There's a quick look at Coinbase, which came off 5% today. Carvana still bouncing around. C3 AI still holding up there. And Royal Caribbean Cruise is climbing higher, as I thought this week. We also got an upgrade from JP Morgan on Carnival today, which sent that stock up. Bit over 12% on volume and helped all the cruises trade a little higher here. And just looking at the weekly chart on RCL, I'm looking for it to come up to 95, 96, and I'm probably going to add to my short position on this, as I think it's technically and fundamentally overvalued, plus it's a good recession hedge in my portfolio. And if we do get the global recession later this year, this thing should absolutely crater. Carl Icahn's stock continues to recover somewhat, and a bit mixed in the banks out there today. A little bit of a pullback in Charles Schwab. S&P 500 oscillator currently at 59.86. Still indicating the market is in an overbought territory and level. And like I said, no indicator is perfect and can forecast the future with 100% accuracy, but it does give you an idea of where the market is. And if you look last time we got really oversold and stayed up there for a little bit was in August last year. You can see in late July it went into overbought levels up here. Then we rallied a little bit higher for another week or two before we peaked out here. And so the indicator can kind of cluster a little bit and give you an idea of where we're at. And I think we may be doing the same here. We could still rip up another 100 or 200 points, but I think we might be starting a bit of a overbought cluster. And I've got a feeling a lot of people are now starting to chase this market with all the media hopping on board, and we're breaking out of those August highs we saw. think a lot of people were using that level as an indicator to say, okay, we're in a new bull market now. And prices could still run higher as there is a bit of momentum in the market. However, I still think the chance of a fake out at this level is high. And we've just got a lot of optimism out there from journalists, the media, retail crowd, and call options. However, if you look at what the billionaires and people who actually manage a lot of money with track records say, they can still see a lot of storm clouds on the horizon. And even though I've been positioned net short dollar-wise for a few weeks now, I still managed to have an up day today. And that's because I'm not short the main indices like the SP 500 and the NASDAQ, which has been absolutely ripping. If you look under the hood at the S&P 500 equal weight, it's actually been trading pretty weak for a couple of months now, and you could still argue that it's in a downtrend or a sideways trend at best, as we're still well off those highs from Feb 2. So you got to be really selective in this market. I wouldn't just short the big S&P 500 or NASDAQ indices here, as there is still a lot of bullish momentum. And for sure, if we get a weak CPI report out tomorrow and the Fed indicates they might be close to being done, then the market could continue rallying, and we could still go up another 100, 200 points on the S&P 500. However, I still think now is lining up for a good spot for the market to do a rug pull, and we are close to a short-term top. And I've seen it time and time again throughout my 20 years of trading. The market kind of sucks everyone in, gets the last bear to fold, the media's all over it, proclaiming a new bull market, a new paradigm or whatever, and then that's when things change course. So as it stands, I'm still tilted 60% net short in my personal swing trading portfolio, and we'll be all looking for that CPI report out at 8:30 tomorrow morning to see what inflation has done. It should come in soft as expected, around 4%. However, I wouldn't still be surprised if the Fed does do a hike anyway and just front load it and get it out of the way, and then they can pause next month. Instead of pausing and then hiking next month, I still think that is a possibility and could surprise the market, especially tech, which doesn't like higher rates. So I guess we'll just have to wait and see. And it should be an interesting couple of days coming up now. And that's all for today. Thanks for sticking with me, and I hope to see you again tomorrow afternoon.